We are delighted to welcome the stock chairman at TradeNet Capital Markets Group, Meir Barak. In this session, Meir will discuss how gaps are an opportunity and will help you to understand how and why gaps occur and how you can use them to make profitable trades. Meir, thank you so much for joining us today.
Hi, thank you very much, Chantal, for introducing me. And yeah, let's start. Are you ready, guys?
We're ready.
Okay. What I'm going to teach you today is my bread and butter. I make money out of trading out of trading gaps. I do that every day. I have my own system. It is nothing I have developed myself. It is something that I've developed through the years based on common knowledge. Just that I'm going to let you through some very specific parts of what I do. And again, if you join my trading room just for a 14-day free trial, you will see me do that each and every day. I usually trade gaps. And one more word before that. In order to make money in this market, you need to have a system. You gotta have a system. You can't just follow each and every trader you find and try and copy and do different things all the time. The only way to make money in the market is to find a very specific system. And I'm not saying you should do exactly what I do, but whatever you learn, whatever you hear, and you may choose to do what I do, just follow some specific rule, develop your own system, a very specific system. Just don't spread around about doing everything. If you try to trade gaps and try to trade breakouts and everything else, I mean, if you start combining everything together, it's not going to end up in a pleasant situation. So what I'm saying to you guys is please find the system that you are happy with and try to develop that. Okay, then let's start. First thing I want to talk to you about, well, just one more word before this, sorry. If you want to read my book, just go to Amazon and look for The Market Whisperer. It's one of the 5 bestsellers in Amazon. It just published 3 months ago. It's out in Amazon and it's called The Market Whisperer, and it's just like $10 or so. Anyway, let's start. I want to show you classic gap. What you're seeing here is a stock that gapped up 2% GILD, and my question is, why is the gap being closed? Let me answer this for you. As you probably know, 80% of gaps are being closed, or you may not know that. In the same day they are open, and most of the time 90% of them would close in the next 10 days or so. So most of the gaps close. However, when I'm talking about gaps that close, I'm talking about gaps that are up to 3%. More than 3% gap, different rules. And we'll talk about this later. But right now, first, to understand, this gap is being closed. Why is this gap being closed? Well, you need to understand that the market is divided in between regular traders like us and, of course, the public, which altogether account to 20% of the volume in the market. 80% is institutional players. Now, the rules of institutional players are totally different than our rules as private traders or as investors. What their rules really do is get them to trade in a way that gaps close. Let me try and explain this. Just imagine a trader who wakes up in the morning and goes to work, I don't know, for Goldman Sachs, Merrill Lynch, whatever. He gets to work and he's being told, you're going to sell today, or not only today, in the next few weeks, you're going to sell 500,000 shares of GILD. Now, they don't buy and sell thousands of shares or hundreds of shares as we do. They sell millions sometimes of shares because they need to remove a lot of money, unlike us. So this trader gets to work and he's being told you're going to send 500,000 shares, for example, this day. And again, he doesn't want to sell them all together at once because that will mean that the price would drop down. Usually it will take him a few days to sell. So let's assume he starts selling here yesterday. That's today, that's yesterday. So if he starts selling here Try to look for the pivot point. Pivot point, and I'm not getting into explanation, is, let's call it the fair value of yesterday's action. So it's probably somewhere around here, the average price of this activity over here. So what it means for the institutional trader is really what he gets as a commission. Usually institutional traders get something like 2 or 3 cents per share that they're selling. So the customer come up to them, ask them to sell 500,000 shares, and they get to work. A trader gets this job, he starts selling shares. If he's going to sell the shares at a higher price, he's going to get a bonus. The bonus may be up to 10 cents. So he's interested in selling high. Now, if you want to learn a little bit more about this, take a look at one of my YouTube videos. And by the way, I record my trading days. You can look for me at my name and TradeNet at YouTube, and you'll see many of my days recorded there. And you can actually see me trading live if you just do that. So look for a lesson about the VWAP, volume weighted average price, to understand a little bit more about how institutional traders make their money. It's very important because they are 80% of the market. So think about this trader. He started selling yesterday. Let's assume he sold 300,000 shares out of the 500. He couldn't sell all because if he would try to sell too many, the price would go down, no bonus, and so on. Now, he wakes up the next morning, he finds the stock gapping up 2%, and from his point of view, and from his customer's point of view, because the stock gaps up and is over the pivot point of yesterday and the close price of yesterday, that means bonus. So there's bonus all the way down. So from his perspective, when he gets a gap up like this, the only thing he does in order to get a bonus is sell the whole way down. As long as he sells and the price is over yesterday's close, he's getting a bonus. So that means, and of course it's not the only institutional buyer or seller, there's plenty of them, they are competing among themselves. So most of the time you will see gaps close because the institutional sellers get a bonus doing so. It's as simple as that. It would usually stop somewhere at this line because there's no more bonus here. So that's the only reason why gaps, not the only reason, of course, there's other reasons. I can talk to you about other issues as well. I'm not getting into it right now, but one of the most important reason is really institutional behavior. Now, it's the same story when you take a look at the stock that gaps down and moves into the direction of closing the gap, just that you need to think about institutional buyers at this time. They buy low, they get a bonus. They buy at yesterday's close, they don't get a bonus. So as long as they buy here, the gap is getting closed. And I'm not getting into this right now, just that you need to realize that most gaps are being closed. Now, you take a look at the daily, for example, dish, whatever, it doesn't matter. You will see that most gaps are closed sometime. Look at this gap that was closed here. Look at this gap that was actually closed there. Look at this gap closing here. This gap closed right over here. So again, if it doesn't close the same day, for several reasons, it will probably close in the next few days. Now, since the S&P 500 or the ETF that we can trade, the SPY, SPY, is really 500 different stocks, then if some of them gap, it also means and we need to ask ourselves, of course, why do stocks gap at all? Well, they gap for obvious reasons, news. Something good or something bad happens. So what you see here is S&P 500 gapping down. Don't ever take the first 10 minutes into consideration. As you can see, there was a big move down at the first few minutes. This is the automized orders at the beginning of the trading day. But once this is settled, you can see that the market moves into the direction of closing the gap. Now, again, if the average of 500 stocks is gapping down and then moving up in the direction of closing the gap, that would also happen for the ETF. So thinking about that, the ETF should close most of the time, and that's true. Again, 80% of the time the gaps will close the same day, and then the rest would probably close in 10 days or so. 90% of them will close. Do you guys have any idea why we crashed in 2008? Anybody know? Well, I'll give you the answer. I'll save the time. It's not because of the subprime issue. We just left the gap open from now 1965. Small joke, trader's joke. Anyway, what we're seeing here, and we closed the gap in 2008, of course, if you didn't realize that's what was the joke about. Let's take a look at this. These are nice 2 days up, a very big gap left open, and whenever I see something like that when I'm trading, like when I'll open my trading day right now today, for example, the first thing I would look is for gaps in the recent day, and I would usually look for them to be closed, as I mentioned earlier. And if you take a look at what happened here, here's the gap and here's the way it closed. It didn't happen now, I'm just giving you an example here, but again, after a few days you would probably see the gap being closed. These were the last 10 days really, when I was in Las Vegas a few days ago, and as you can see, this was a presentation I did in Las Vegas a few days ago, but as you can see, all of these gaps have been closed apart from this one, but anyway, I'm not going to get into it. One important thing that you need to look out for is gaps in dual traded stocks. You don't want to trade gaps in dual traded stocks. Like for example, Toyota is being traded on the Japanese market. That means that when you find a gap, you don't want to trade it because it's not a vacuum. It's something that was traded. It's price that was traded on a different stock exchange. So beware for that. TM Toyota, the way to look for this is very simple. Click on the daily chart, and if you see something like this is the daily of Toyota. If you see something like this, and something like this means that there are plenty of gaps almost each and every day, it doesn't mean that this stock is gapping each and every day. It just means that it was traded on a different stock exchange. Don't touch it, okay? Don't touch it. Different rules. Not today, some other time. Anyway, is there a way to make money out of closing gaps in the S&P 500? Sure there is. Let's see. Let's try to work out a system here. And the system is based on the S&P 500 closing the gaps. And this is a very, very simple to execute system, and you can make some money out of it. It shouldn't be the only thing you're doing, but if you're trading gaps like me, this is something you should be doing at least once or twice a week. And let me tell you what you're supposed to be doing here. Well, first of all, if you know that most, not all, of the S&P 500 gaps are being closed, then you can figure out that you can short or long it at the open. So your entry point when you have a gap in the S&P 500 is long or short depending on the direction of the gap, of course. So S&P 500 has to gap a minimum of 20 cents. Otherwise, it's just not interesting, okay? So you need to be looking for a gap of at least 20 cents. The gap has to be no greater than 80% of yesterday's range. Now, what do I mean by that? If you had, for example, a move yesterday, I don't want to say big move, but if the gap of today is greater than the whole range of yesterday from the high to the low, it means that this is a very big gap today. I'm talking about a regular day, okay? Like if you're going to have like a non-move, the market doesn't move today and tomorrow you're going to have a gap, then it's a different rule, of course. But when you have a regular day, let's call it, and I'm not getting into explanations here exactly what is regular, but when you have a regular, let's call it day, and today it moves no more than 85% of yesterday's, the gap is no more than 85% of yesterday's range, that means it's a reasonable gap. So I don't want to see a gap which is too small, less than 20 cents, and I don't want to see a gap which is too big, because then again different rules apply. So it has to be, the same idea with the 20 cents, it has to be no less than 15% of yesterday's range. Okay, that's the same thing really. Now, where's the exit? Very simple, just when the gap is closes. So what, or at the end of the day. So you don't take it for a swing, you just close it at the end of the day, no matter what. So when the gap closes or at the end of the day, you close your trade. So you shorted or longed at the beginning of the trade based on these assumptions, and let's see what the results are. And I didn't do that myself. I gave it to a programmer who works with me and did it himself. So these are really the results. And this was tested for 3 years, 471 gaps, assuming that you invested $16,000 in each trade. Here are the results. Your maximum profit per trade would be $373. Your maximum loss per trade, now this is bigger because you wait until the end of the day, and sometimes there's a big moving day and you just didn't expect that. So your maximum loser would be bigger. Your average profit would be $55. Your average loss would be $145. Your success rate would be almost 82%. And this is what I was talking to you about yesterday, that most gaps close. Even if they didn't close, you could still make money because they are moving into the direction of closing the gap. Your weight success, however, is just 63%, because if you take into consideration that you're losing more than you're winning, then the real way to count it is by weight success rate, and that's not bad, that's good. My personal success rate in trading, by the way, is 68%. This is not a game that you can win all the time. So if you invested $16,000, you would end up that year making $9,000. That's not bad. That's an annual yield of 17%. So it doesn't take much. It doesn't take much thinking even. It's just take knowing the rules, clicking the button, and coming in later. You can leave an automated limit order in the system, come back a few minutes before the trading day is over, click that button, move out. And if you're experienced, you can also figure out better days and days which you would not like to do that. So if you use a computer software, you can make that. If you're a good trader, you can actually make more than that. But that works, and you can do money out of trading gaps this way. However, this is just the first part of what I want to show you. The most important part really is trading gaps which are bigger than 3%, usually bigger than 3%, not always, usually bigger than 3%. First thing I do, I look for gaps which are larger than 3%. Every day I get that. There's hardly days where I don't get that. So these are all examples of the last few weeks. These are all trades that I took in the trading room, and when I take a trade like this in my trading room, I post it. It will be posted before I click the button. I will show my screens. I will show everything. You could do the same with me. And again, I invite you to join my trading room for a 14-day free trial. And by the way, after this trial, it's just $120 a month. So it's and again, I don't make money out of that as well, and not also from selling books, if you wondered. So really, this is the kind of trade I'm looking for. MYGN is gapping down 8%, and I'm thinking to myself whether I should short it over here. Now, you don't know my trading style. Yes, I would like to short it over here based on the intraday. However, before I take a decision, I would first always look at the daily. So what do I see on the daily? This is the daily of MYGN, and I don't show you I will not show you the result right now. I'm just showing you where it started. Right over here, it started at that green X. So it started, it gapped down to this point. So the first thing I'm thinking, and I'm not always having an answer, but the first thing I'm thinking to myself is, well, let me ask you, do people really, if you were an investor now, most of the people out there are not traders like us, okay? We are very, very small minority. If you were an investor and you would see MYGN like this, gapping down, would you sell it? Yes. Why? Or would you hold it? N for no. Please click, and I see it running on my screen because I can only see one at a time. So click yes if you sell it, and click N if you hold it. You sell, okay. Charles would sell. Nicholas would hold. Michael would hold. Thank you guys for answering. David would hold. That's an N for no. Arturo would sell. So we got like 50-50% right now. And Tom would hold. Sell again 50-50. Interesting results. Thank you, Agab. Okay, let's continue from here. Well, those of you said sell are been probably trading a little bit too much or too long or being traders or having the mentality of a trader. Guys, nobody would sell something like that. Nobody would sell something like that. Take a look at the daily. Most of the people are in the money. In the money. Imagine, I mean, take a look at what we see here. Of course, based on what we see here. At this point, only these people who bought over here are losing money. Only these people who bought over here are losing money. Most of the people are in the money. If I would do the opposite, I'm not even sure. If I would show you something which is downtrending, maybe that's a different issue. But right now, they love it. It's down 8%. I'm not sure they're going to sell. I personally think that most people are really going to hold it. They're not going to sell it. So the first thing they would actually do is really use this gap down in order to buy some more. Most people would buy some more. Most people would actually have automated orders which say, okay, we bought it at 29, we bought it at 34, we bought it at 37, we bought it at 39. It's looking great. We love it. We absolutely love this stock. Look at this uptrend. They love it. They don't hate it. They love it. So it's moving up. They love it. And at this point, they don't really want to sell. Some of them would have automated orders to buy. Listen to this, to buy. Once it's down, they will not buy it at 39, but they could have an order saying, okay, if it's, well, they will put an order in the system saying, well, if it's down to $35, for example, I'll buy. If it's down to 36, I will buy. If it's down to 37, I'll buy. All of these automated orders usually come out at the first 10 minutes of the trading. So what you're seeing here is the stock moving up in the first few minutes. And by the way, these are 2-minute candlesticks, which I use at the beginning of the trading day. I actually use sometime at the beginning, I actually start by using 1-minute candles at the beginning. So these are 2-minute candles. The first reaction is moving up. These are usually automated orders. Now, what happened next is that it starts slowing down. I don't know what comes next. It could continue up and close the gap. However, that's rare because it started down 8%. Now it's making a small reversal over here, and my system says that at this point you should short it, because at this point some weak hands are coming in. Usually the weak hands come in after the first few minutes. They are watching the price move up, they are happy. Once it starts moving down, and I have absolutely no idea why it moved down, and I don't care, but once it does do this reversal over here, I'll be on the short side once I see a very clear reversal. And I'm not getting into the technical reversal rules and everything. You're supposed to be knowing that. Most of you guys have experience, so I'm not getting into reversal patterns, but this is a very clear reversal pattern, and I want you to do the same thing I do. Don't do it alone. Start training with me for a while, and let me explain to you that live when I do it, why I do it, and when I'm moving in and when I'm moving out. But this is what I want you to do. Now, my next question for you guys is, where is your stop? Because it's not enough to know where's your entry. It's also important to know where's your stop. By the way, all of these trades were taken in the trading room, as I mentioned earlier. You would have seen me doing that with you. So that's, by the way, quite a nice move from $35 down like 75 cents, a little bit more, like 80 cents, maybe more, maybe a dollar, I can't remember. So anyway, it was a nice crash here and very nice trade. So taking a look really at what happened here, before I enter this trade, I need to know where's my stop. So I'm asking you guys to please tell me where your stop is. So Charles just clicked $36. Thank you very much, Charles. Any other prices? And by the way, this is 36 right over this stop over here. Okay. Try and figure out where would be your stop. 35.75, which is well, actually slightly lower than the high. Okay, slightly lower than the high, right over there. Okay. 35. Okay, I moved in at 35. Okay, any other answers? Okay, top. The top is approximately 36 or a little bit below 36. Okay, I didn't see any right answer. Let me give you my answer. My answer is not the technical answer that you would usually hear. Well, I don't know exactly what you mean, David, but you may be right. Okay, so what my answer would be this. I want you to imagine. I want you to imagine. I don't want you to read technical books, because if you're going to read technical books, you're going to lose money. If you're going to learn by heart a technical book, I don't know, I don't care which, and you're going to do exactly what's written in technical books, you're going to lose money. I want you to imagine, where is your stop? Your stop should be, to my opinion, here, somewhere around here, at this point. Now, if I try and, let me do something like that. Okay, sorry. So that's probably 35.40, okay? Something like 35.40, this line over here. That's your stop, to my opinion. Imagine this. You started, you took a short, it didn't work out. Now, forget about this. And again, you know what? Let me do that. Forget about the result, because you don't know what the result. It just moved down. Let's assume it moved down a few cents, stopped right over here, and then started moving up. Just imagine what happens here. If it moved all the way to here, imagine the place where at the point where it moved up, at this point, there's more than, let's say, 70% or 80% that it will continue move over the highs. So what is the point? Where is the point where you can say to yourself, there's, let's assume, 80% chance that I'm going to lose money on this trade. I tell you that this point is right over here. You don't have to wait to the high of this candle or to the high of that candle. You don't have to wait for the clear technical reversal that you read in the textbooks. You don't in the trading books. You have to stop somewhere around here, because at this point right over there, this is where you actually lose. Most likely loss. So what I'm saying is, just imagine. You need to imagine. You need to think about the point where you need to move out. We don't have much time. Let's continue with some rules here. Prefer a 3% or more gap. Check the daily chart as we did right now. Prefer reversal. That's a reversal. Don't prefer breakdowns. Wait for the first 5 minutes. You don't want to take the trade before the first 5 minutes. Plan your target. We didn't talk about that. Plan your stop and take it to 75% partial. If your stop is over there, like 45 cents or so, that should be your first target too. So assuming you shorted, let's say, 1,000 shares, I expect you to move out of approximately 700 or 800 shares at a profit of 45 cents. Now, of course, you can take a look at the buyers and sellers and decide live if you can take a little bit more than that. But if you're not totally sure it's going to continue moving down, you should take your partial somewhere around there. And again, not at the top here. That's your stop around 45 cents, and that's your target around 45 cents. That's it for this trade. Let's talk about this one. That's a different issue here. What we see here is a gap down. Biogen, BIIB. However, a very nice breakdown formation. I rarely take those because I rather take reversals. However, this reversal occurred very close to the lows. So really, I waited for this stock to move to the lows. But what you see here is a very nice downside momentum. This is different. It didn't start by moving up. It started by moving down. I never take the first move down because you never know where it's going to reverse. Don't ever, never do that. You wait for a pull back up. Only if you get a pull back up, then look for reversal and short it. As we've seen here, again, a move to the upside. It could start with a move to the downside, but a move to the upside, a pullback, and then you short it. You never ever take a short over here. Okay, never ever do that. Wait for a pullback. And at this time, when you see a very good momentum, you could short it. This is a trade we took. And again, before that, you take a look at the daily. There's nothing I can say about the daily here because really, as you can see, it doesn't go anywhere for the past I don't know how many months. It gapped down. It's not uptrending. It's not downtrending. So there's nothing wise I can say about what we're seeing here. But you just need to take a look at the daily. The outcome was huge. I mean, that was a 10 point winner. I do remember moving out of it after 6 points, but I took my partial way before that, because again, if you try and figure out where's your stop should probably be somewhere around here, before this high, okay? Somewhere around here. That should be your target. However, I did get the first target much better than that. Nevertheless, it was a nice trade, a nice continuation. So don't ever short the first move down. Wait 5 minutes, and again, plan your stop, target, and your quantity according it. This is an example of a stock that started by gapping down, and my question again is, should you short it? And as I mentioned to you earlier, never ever do that. Never ever before a pullback, because you never know where it's going to stop and start moving up. You never know that. So never short something that looks like that. That's, by the way, the daily. And again, nothing wise I can tell you about the daily over here. Sometimes you see something interesting, so you need to take care of this. Sometimes you just don't. Now, look what happened here. It continued moving lower. However, take a good look at this topping tail over here. If you would have shorted it somewhere around here, you would probably be out of the trade because of this tail, because it did move up, then move down. So you're most likely, if you took this trade, you'll most likely finish with a loss, because that was a big move over here, okay? I mean, that was like, again, let me use that, because I need to take a look at the prices, from 1330 all the way to 1380 or so. So we're talking like 50-cent move. I couldn't survive that if I would have shorted it. Now, of course, the outcome was amazing, but again, I'm telling you, you never know where it's going to pull back. Never ever take these kind of trades. I just have a few more seconds, so sorry, I'll have to run to other trades. CRM gapping up. Does it look like a good short? Most people would like to short it. Here comes another rule. Never ever short a gap up. Never ever short a gap up. I know that gaps up sometimes close the gap, but this is a 4% gap up. It started by moving higher. You never ever do that. It's strong. People love it. Look at the daily. It just moved up. For the past few months, it's moving up. It's just gapped up. People love it. They would most likely buy it. Look for a reversal. I know you could have shorted it, and maybe this would have been a profitable trade. I don't care. Don't win in the wrong way. Wait for a reversal. If it's over the lows, this is one important rule. If it's over the low, wait for a reversal and move in. It gapped up. You're not supposed to be shorting it. You're just supposed to be longing it. Okay? Okay, so don't short a gap up. Look for a long reversal, and don't long a reversal if it is under the lows. Should we long a stock that is moving down, like eBay? In this case, the answer is yes, but this is based on what happened yesterday. So as you can see here, eBay was up 5%, and it pulled back because of some weekends that started selling because of yesterday's move. A few days ago, again, a few weeks ago really, this was the day when eBay announced that it's going to IPO PayPal. So it moved up, very big move up intraday, and then moved down the beginning of the trading day. Some automated sellers there taking profit, and at this point it could be long, and it worked nicely for a while and then stopped. But again, I'm not saying you shouldn't be longing anything. I'm just saying that sometimes you need to take a look at the daily or the day before to understand what you're doing. So look for momentum stocks. Look for reversal in the direction of the momentum. That's the direction of momentum. Look for that. Again, a move to the upside. Should we take it long? However, take a look at yesterday. Does look like the momentum is up. Should we take it long? That's a nice technical pattern to take it long. My answer is totally no. Why my answer is no? Because I'm taking a look at the daily. Take a look at the daily. It gapped down yesterday and then moved up. However, it is down today. but it's down 40% or so. Look at that. It still is down. Institutional buyers will not touch it with a stick. Some investor may average down, meaning they will buy. So they bought it yesterday. They will probably not continue on buying it today. So it's most likely really to do nothing or to move down. Well, it started by moving down. Maybe you could short it. I'm not recommending on that either, but it didn't do much. So based on the daily, and again, here's the daily, you shouldn't be touching that because it gapped down 40%. And again, always take a look at the daily. This is what the most important thing. So look for momentum. And this time, the momentum was down. Look in the reversal, in the direction of the momentum. You like to short it here? That's a possible trade. Again, look at Baba. Should we short it? It gapped down, it gapped up. Should we short it? That's an amazing technical pattern. In every technical book you will read that you're supposed to be shorting something like that. And again, I would tell you the same answer. Never ever do that, because look at Baba, where it happened. Everybody love it. Still love it, by the way. Everybody love it. So it moved, it gapped up, started moving down. And again, maybe this could have been a good trade, but you never know where it's going to stop, reverse, and move up. Never ever short something which is gapping up. So again, look for momentum, look for reversal in the direction of the momentum. In this case, it's long. That's another example here, but I don't have any time to discuss it anymore. So I'll just finish with, again, some more, maybe just this for a second. This is the one I like, as I mentioned earlier. That's really my bread and butter, moving up at the beginning of the trading day and then moving slightly down, nice reversal, and shorting it right over here. That's an amazingly good looking short. The question is whether I should short it, because if you take a look at the daily, it's very, very strong. So big question here is whether I should short it or not. But the answer is also very simple. Guys, this is a biotech company. Okay, this is a biotech company, and sometimes you need to combine technical rules with fundamental rules. And in this case, biotech companies are all over the place. People love it, however, they hate it once it starts moving down. They're very afraid of it. So it's like love-hate relationship all the time. So when you see something like that, it's most likely to crash down, as it did. Well, it did move higher, but I did get a fantastic trade over here. So this is really the kind of trades that I'm looking at. Just to summarize, that's it. Never chase a gap. Prefer 3% or more gaps. Don't show a gap down of well-known companies. We didn't talk about that. If I would see something like that, guys, happening, for example, in a company like Coca-Cola, Disney, Walmart, stuff like that, I will not short it, because people still love it. People love to buy Disney where it's down, Coke when it's down. I don't know, those kind of companies, and I'm not getting into names here, but well-known companies, don't do what I just described to you, okay? You may want to long them. That's a different issue. We didn't discuss that today. You may want to long them. Always check the daily chart. Look for volume of over 2 million shares a day. Always prefer reversal entries. Don't trade the first 5 minutes. Plan your stop target. And when I say plan your stop target, not just the technical book, just imagine. Really, guys, work with your imagination. Trading is anywhere between being 100% technical and being 100% artist. It's somewhere in the middle. You need to be a little bit artistic. Take a minimum partial, to my opinion, of 75%. Don't short the gap up, and don't log a gap if the price has moved under the lows. I hope this presentation was beneficial to you. Thank you, Charles. I'm glad you like it. Thanks. And
Meir, thank you.
Yeah.
Thank you so much for joining us.
Yeah, I love that. I love that. Thank you for the chance of being here. And the guys, I would love to see you taking my 14-day trials free of charge, of course. You don't need to use any credit card or whatever. And thank you very much for hearing me.
Of course. I'm going to go ahead and take back controls from you now. You have a wonderful evening.
Thank you.
Thank you, sir.